For Your Money is brought to you by NelsonCorp Wealth Management.
It's now time for Your Money. We're joined by David Nelson, CEO of NelsonCorp Wealth Management. Welcome back, David.
Thank you, Brandy.
The first couple of quarters of 2021 have had a remarkable earnings rebound, but you say there's more to this story. Share with us your thoughts on that.
Yeah, there really is. Earnings get all of the attention as far as in the media. And unfortunately, again, we think a more important one that folks should be looking at. I brought along a slide to illustrate this, and it's going to be a really nice visual for folks. So we've got a lot of action on here, but I'll try to explain it. So we think profit margins are key. And if you look at the very far right, we've got it circled. We're at record highs for the S&P 500 as far as profits are concerned, and profit margins are concerned. Now, if you go back to the far left, what you see is that's going to be in the 1990s, and then the middle is going to be the 2000s. You see profits that are running at roughly 8%. The peak, it was 8% for the 90s, 9% as far as for 2000s. And gosh darn, today we're over 11%. So these are just bone-crushing numbers. And it probably explains the massive rally that's taking place over the last year or so.
So tell us, how do the financial markets tend to react to profit margins?
Pretty quickly and abruptly sometimes, favorably in recent times because of what's taken place as far as the snapback that we've seen as far as in corporations from COVID here. But it's interesting that what folks would perceive probably corporate profits hitting all-time highs would translate into market should be probably hitting all-time highs. That's not always the case. Usually it's just the exact opposite. You see the lulls as far as in the economy and the market. Typically you're going to see a snapback, and it's going to be very dynamic as far as when those profits turn as far as on an upward trajectory.
So what do you think we could see going forward with regards to earnings and profits?
So it's very industry specific. And so if we look at technology profits are just off the charts. More specifically, software profits are really off the charts. Now, so that's terrific. And again, as people could probably surmise, because of that and the growth of technology and what's taken place, it's a bigger part of the S&P as far as the S&P 500 index. Now, if you look at energy and industrials, very intensive as far as investment that goes into that, unlike technology and software, fixed costs, much better. So keep an eye on the potential tax increase. That's probably the biggest driver right now. If we get this tax increase, we're probably going to see a pretty significant bump as far as in the market.
If you missed any of our discussion, we'll make it available for you on ourquadcities.com.